Chapter 18, Money and Banking System. Banks are financial institutions which accept deposits and lends credit with growing financial needs. Banks have become the backbone of the country's economy. Banking sector of India is well structured so as to suit the aspiration of common people. Money. Money is historically an emergent market phenomenon a, establishing a commodity money, but nearly all contemporary money systems are based on fiat money. It drives its value by being declared by a government to be legal tender. It must be accepted as a form of payment within the boundaries of the country for all deposit, public and private. Such laws in practice cause fiat money to acquire the value of any of the goods and services that it may be traded for within the nation that issues it. The money supply of a country consists of currency, banknotes and coins, the bank money, the balance held in checking accounts and servicing accounts, saving accounts. Bank money, which consists only for records, mostly computerized in modern banking, form by far the largest part of the money supply is in developed nations. Components of money supply. It is the stock of liquid assets held by the public which can be freely exchanged for goods and services at a particular point of time. RBI calculates four concepts of money supply. These are known as measures of monetary aggregates or money stock measures. The most important components of money supply laid down by Reserve Bank of India are given below. M1 measure of money supply. M1 as a measure of money supply has been found highly useful for the monetarists in their theoretical analysis of income, price level and money supply. M1 equal to C plus DD plus OD, where C equal to currency, which includes paper money and metallic coins of all denominations. D equal to net demand deposits with banks, which include the savings deposits with the bank, and OD equal to other deposits with RBI, which include the deposits with RBI of quasi-governments institutions such as Industrial Finance Corporation of India, State Finance Corporation, Industrial Development Bank of India, Agricultural Refinance and Development Bank of India, Agricultural Refinance and Development Corporation, deposits of International Monetary Fund IMF in account number 2. Deposit of foreign governments and foreign central banks and deposits of RBI's employees cooperative credit societies. It must be noted that the other deposits with RBI here do not form the part of deposits of government commercial banks and deposits of IMF in account number 1. M2 measure of money supply. These components of money supply is devised to include post office savings deposits in the M component of money supply in order of liquidity. M2 ranks next to M1. M2 equal to M1 plus saving deposits with post office savings of public. M3 measure of money supply. M3 is the sum of M1 and the time deposits of public with banking system. Hence it represents a broader measure of money supply and is known as the aggregate monetary resource AMR. M3 as a measure of money supply is shown preference not only by RBI but also by economists. Even Chakraborty committee favored M3 to M1 as a measure of money supply. The intention of RBI might be to impart a high level of liquidity to the time deposits. M3 ranks below M1 and M2 in liquidity. M3 equal to M1 plus time deposits of public with banking system. Note: according to many economists, time deposits should not be included in money supply due to their non-uniform maturities and their resemblance with non-money financial assets. M4 measure of money supply. M4 is the sum of M3 and all deposits with post office excluding national certificates. M4 is an extension of M3. M4 equal to M3 plus total deposits with post office excluding national savings certificates. Note: RBI provides estimates of money supply on regular basis in terms of M1, M2, M3 and M4 to indicate in fluctuating degree of liquidity of different components of money supply, while M1 and M2 provides the precarious measures of money supply. M3 and M4 provides it expensive measures. RBI working group on money supply headed by YY Reddy recommended for dropping of post office saving deposits. Accordingly, there are now only three monetary aggregates, viz. M1, M2 and M3. Liquidity aggregates. The working group under the chairmanship of Dr. Y.V. Reddy, then Deputy Governor of RBI, now former Governor of RBI, has suggested three liquidity measures, which are as follows: L1 equal to M3 plus all deposits with the post office savings banks, excluding national savings certificates; L2 equal to L1 plus term deposit with term lending institutions and refinancing institutions, FLS, plus term borrowing by FLS plus certificates of deposit issued by FLS; and L3 equal to L2 plus public deposits of non-banking financial companies. Banking conventionally is defined as the acceptance of deposits of money from the public for the purpose of lending and or investment. These deposits are repayable on demand or otherwise and withdrawn by a check, draft, order, etc. Deposits are accepted from individuals as well as from firms. In sum, the nature of banking business can be summarized in two words: financial intermediation, which needs to be carried out efficiently for stimulating the real sectors of the economy. Banking in India, as elsewhere, takes diverse forms, which banks formed under special status companies registered under the Companies Act 2013, or foreign companies and cooperative societies registered under the Cooperative Societies Act. Banks are classified on their ownership patterns such as public sector banks, private sector banks, and foreign banks. History of banking in India. Banking system has been existing in India since ancient times, though it was not in organized from before the bank. Before the arrival of Britishers, but various banking activities were performed. After the arrival of Britishers in 17th century, foreign banking system started declining. Mayors Alexander and Company established the first European bank, the Bank of Hindustan, in 1770. The development of banking system in India can be understood with the help of following chronology. We can summarize the origin of banking in India in the following ways. The first bank in India, the General Bank of India, was set up in 1786. Bank of Hindustan and Bengal Bank followed. The East India Company established Bank of Bengal 1809, Bank of Bombay 1840, and Bank of Madras 1843 as independent units and called them Presidency Banks. These three banks were amalgamated in 1920 to form Imperial Bank of India, a bank of private shareholders, mostly Europeans. Allahabad Bank was established exclusively by Indians in 1865. Punjab National Bank was set up in 1894 with headquarters in Lahore. Between 1906 and 1913, Bank of India 1906, Central Bank of India 1911, Bank of Baroda 1909, Canara Bank, Indian Bank 1907, and Bank of Mysore 1913 were set up. Awadh Commercial Bank was the first bank established in 1981 and governed exclusively by the Indians on the basis of extending loans. To streamline the functioning and activities of commercial banks, the Government of India came up with the Banking Companies Act 1949, which was later changed to the Banking Regulation Act 1949. In 1991, under the chairmanship of M. Narasimham, a committee was set up which worked for the liberalization of banking practices, nationalization of banks. The nationalization of commercial banks took place with an aim to achieve social welfare, controlling private monopolies, expansion of banking, reducing regional imbalance, priority sector lending, and developing banking habits. Nationalization took place in the following phase in 1969. In order to have more control over bank, on 19 July 1969, Mrs. Indira Gandhi, the then Prime Minister, nationalized 14 large commercial banks whose reserve were more than 50 crore. Following is the list of banks which got nationalized at that time: Allahabad Bank, Bank of India, Central Bank of India, Dena Bank, Indian Overseas Bank, Syndicate Bank, Union Bank or Bank of Baroda, Bank of Maharashtra, Canara Bank, Indian Bank, Punjab National Bank, UCO Bank, United Bank of India. In 1980, on the 15th April 1980, the banks with more than 200 crore of reserves got nationalized. Those six banks which got nationalized are the following: Andhra Bank, New Bank of India, Punjab and Sindh Bank, Corporation Bank, Oriental Bank of Commerce, Vijay Bank. In 1993, later on in the year 1993, the government merged New Bank of India with Punjab National Bank. It was the only merger between nationalized banks. After merger, total nationalized banks were 19. In 2015, in the year 2015, ING Visa Bank merged with Kotak Mahindra Bank in the all-stock deal with 148.51 billion or US 2.4 billion US dollar. In 2017, in the year 2017, five associates State Bank Bikaner and Jaipur SBBJ, State Bank of Hyderabad SBH, State Bank of Mysore SBM, State Bank of Patiala SBP, and State Bank of Tranvacor SBT, besides Bharatiya Mahila Bank BMB, became part of State Bank of India SBI, which propelled it as country's largest lender, as well pushed it as among the top 50 banks in the world. In 2019, the Union government on 13th August 2019 unveiled a mega plan to mega 10 public sector banks PSBS into 4 as part of plans to create fewer and stronger global sized lender as it looks to boost economic growth. The government has decided four new sets of merger which are as follows. Oriental Bank of Commerce and United Bank of India merged with Punjab National Bank to form the national second largest bank with 17.95 lakh crore business. Syndicate banks merged with Canara Bank to create the fourth largest public sector banks with 15.20 lakh crore business. Andhra Bank and Corporation Bank merged with Union Bank of India to create India's largest public sector bank with 14.59 lakh crore business. Allahabad Bank merged with Indian Bank to create the seventh largest public sector bank with 8.08 lakh crore business. In 2019, state-run Bank of Baroda (BOB) has become India's third largest bank after its merger with Dena Bank and Vijaya Bank, beating private sector lender ICICI Bank. This was also India's first ever three-way consolidation of banks in India. Types of banks. Banks can be broadly classified as commercial banks and cooperative banks. Commercial bank. Commercial bank are those profit-seeking institutions which accept deposits from public and advance money to individuals like businessmen, household entrepreneur, etc., with the prime objective of earning profit in the form of interest, commission, etc. The main source of income of a commercial bank is the difference between these two rates which they charge from borrowers and pay to depositors. Classification of commercial banks is as follows. Commercial bank, scheduled commercial bank, non-scheduled commercial bank, or scheduled commercial bank হচ্ছে public sector bank, private sector bank, foreign sector bank. Public sector bank হচ্ছে কি SBI and its subsidiaries banks, nationalized banks, regional rural banks. Scheduled commercial banks, all banks which are mentioned in the second schedule of RBI Act 1934 are known as scheduled banks. Scheduled banks can further be categorized as follows. Public sector banks. It is a bank in which the government holds a major portion of the shares. The State Bank of India, along with all nationalized banks and RRB, are the public sector banks. SBI. State Bank of India (SBI) is the country's largest commercial banks in terms of assets, deposits, and employees. It is a government-owned corporation which offers a wide range of general banking services from loans and advances to a cooperates and individuals in India and abroad. Note, all subsidiary banks of SBI and Bharatiya Mahila Bank have been merged into SBI in April 2017. Regional Rural Bank. In 1976, the Parliament enacted the Regional Rural Banks Act 1976 to provide for the incorporation, regulation, and winding up of regional rural banks (RRBS). The act has been made effective from the 26th September 1975. The equity of the RRV is contributed by the central government, connected concerned state government, and sponsor bank in the proportion of 50 is to 15 into 35 is to 35. The RBI, which is the regulatory authority for the RRV in accordance with the provisions of the Banking Regulation Act 1949. The Banking Regulation Act empowers NABARD to undertake the inspection of RRBs. The objective of the RRB is to develop the rural economy by providing for the purpose of development of agriculture, trade, commerce, industry, and other productive activities in the rural areas, credit and other facilities, particularly to the small and marginal farmers, agricultural laborers, artisans, small entrepreneurs, and for matters connected three with therewith an incidental thereto. A regional rural bank seeking permission of the Reserve Bank for opening branches has to obtain the recommendation of NABARD. RRB Amendment Bill 2014 was the amendment to raise the authorized capital of RRBs from 5 crore to 2000 crore. The bill also provides that authorized capital of any RRB shall not be reduced below 1 crore. National Bank for Agriculture and Rural Development NABARD. National Bank for Agriculture and Rural Development NABARD is one of the subsidiaries where the majority stake is held by the Reserve Bank. NABARD is an apex development bank with a mandate for facilitating credit flow for promotion and development or agriculture, small scale industries, cottage and village industries, handicrafts, and other rural crafts. It also has the mandate to support all other allied economic activities in rural areas, promote integrated and sustainable rural development, and secure property of rural areas. Other nationalized banks on 19 July to 1969, major 14 Indian commercial banks were nationalized in 1980. Another 6 banks were nationalized till the year 1980. Approximately 80% of the banking segment in India was under government's ownership. The following is the list of all nationalized banks: Allahabad Bank, Bank of Baroda, Andhra Bank, Bank of India, Bank of Maharashtra, Central Bank of India, Indian Bank, Dena Bank, Oriental Bank of Commerce, Punjab National Bank, UCO Bank, United Bank of India, Canara Bank, Corporation Bank, Indian Overseas Bank, Vijaya Bank, Punjab and Sindh Bank, Syndicate Bank, Union Bank of India. Private sector banks, all those banks where the greater parts of the stake of equity are held by the private shareholders are called as private sector banks. In India, private sector banks are known with two names: old private sector banks and new private sector banks. The banks which were not nationalized at the time of nationalization of banks that took place during 1969 are known as the old private sector banks. These were not nationalized because of their small size and regional focus. The banks which came in operation after 1991 with the introduction of economic reforms and financial sector reforms are known as new private sector banks. Banking Regulation Act was the amended in 1993, which permitted the entry of new private sector bank in the Indian banking sector. Payment banks. Reserve Bank of India (RBI) released guidelines for license of payments banks on 27th November 2014. These guidelines will allow mobile firms and supermarket chains, among others, to enter the banking arena to create to individuals and small business. The objective of payments banks is to push financial inclusion by providing small savings accounts and payments or remittance services to migrant labor workforce, low income household, small business, other or unorganized sector entities, and others users. Airtel Payment Banks Limited launched India's first live payments bank in Rajasthan on 23rd November 2016. Small finance banks. RBI had released the guidelines on small finance bank along with the payment banks on 27th November 2014. The objective of small finance banks is to further financial inclusion by providing basic banking facilities to the unbanked and thereby boosting saving habits. Supply of credit to small business units, small and marginal farmers, micro and small industries, and other unorganized sector entities through high technology, low cost operations. Foreign foreign banks. Foreign banks are allowed to operate in India through branches and representative offices. A new foreign bank de- 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 desi- desirous of opening a branch in India is required to apply to Reserve Bank of India, giving relevant information about its shareholders, financial position, and the dealing with Indian parties. The request is examined keeping in view the financial soundness of the bank, international and home country, ranking international presence, economic and trade relations between the two countries, and supervisory standards in the home country, etc. At the end of April 2013, 43 foreign banks from 24 countries were operating in India as compared to 34 banks at September in 2010. Non-scheduled commercial banks. Non-scheduled commercial banks are depository or lending institutions that do not meet the second schedule of RBI Act. The banks that are not included in the RBI Act 1934 are defined in the clause of Section 5 of the Banking Regulation Act 1949. The bank has no pay compulsory a reserve capital of 5 lakh to the RBI, and this capital must be maintained throughout their operational period. Cooperative banks. Cooperative banks have also played a limited but important role in the banking system of the country. Scheduled cooperative banks consist of scheduled state cooperative banks and scheduled urban cooperative banks. State cooperative banks. State cooperative banks means the principal cooperative society in a state, the primary objective of which is the financial of other cooperative societies in the state. Urban cooperative banks (UCBS) are registered under the Cooperative Societies Act of the respective state governments. UCBS having a multi-state presence are registered under the Multi-State Cooperative Societies Act and regulated by the central government. Besides, the Reserve Bank also has regulatory and supervisory authority on bank-related operations under certain provisions of the Banking Regulation Act 1949 as applicable to cooperative societies. UCBS are included in the second schedule of the Reserve Bank of India Act 1934, provided their net demand and time liabilities are at least 100 crore and subject to certain other related criteria. Functions of commercial bank. Receive deposits. The most important activity of the commercial bank is to mobilize deposits from the public. Depending upon the nature of deposits, fund deposits with banks also earn interest. Thus, deposits with the banks grow along with the interest earned. Some of the important deposits accounts are as given below. Current account. Current account is a type of deposit account that create to the need of professionals and businessmen alike. These deposits are the most liquid deposits, and there are no limits for numbers of transactions and amount of transactions in a day. Saving account. It is generally opened in bank by salaried persons or by the persons who have a fixed regular income. This facility is also given to students, senior citizens, pensioners, and so on. The saving account holder is allowed to withdraw money from the account as and when required. The interest which is given on saving accounts is sometimes attractive but often nominal. Fixed account, a deposit of money that pays higher interest than a saving account but impose conditions of the account. Frequency and or period of withdrawals is called fixed account. Cash credit account, it can be opened as per terms and conditions of sanction of given credit limits. The rules when prescribed for the current account is capable to cash credit accounts in addition to the sanctioned terms and conditions. Recurring deposit account. In banking terminology, the term recurring deposit refers to the periodic placement of a fixed sum of funds with a bank or financial institution into a special term account with a specified tenure, generally between 1 and 5 years. At the end of tenure, the funds with accrued interest are typically withdrawn by the depositor to lend money. Another important function of a commercial bank is to grant loans and advances. Such loans and advances are given to the public and business community at a higher rate of interest than allowed by banks on various deposit accounts. Types of loan of commercial banks are given below. Overdraft, retracement of exchange bills, data and loan, cash credit, agency functions, collection of checks, dividends and interest, payment of rent, insurance premiums. Dealing in foreign exchange, purchase and sale of securities, act as a trustee, executor, attorney, etc. Act as correspondent, preparation of income tax returns, miscellaneous function, issuing letters of credit, travelers check, circular notes, etc., undertaking safe custody of or of valuable important documents and securities by providing safe deposit values or vaults or lockers, underwriting of shares, debentures, etc., underwriting loans floated by government and public bodies. Central bank. The central bank is the apex bank of the country which controls and regulates the functions of commercial and cooperative banks. RBI is the central bank of our country. RBI was set up on the basis of Hilton Young Commission recommendation in April 1935 with the enactment of RBI Act 1934. The Reserve Bank of India (RBI) is the apex institution of our country. Is monetary system. Since the monetary system is basic to the financial system of a country. The central bank also functions as the apex institution of the entire financial system, organization and management of RBI. The executive head of the RBI is called the governor, deputy governor, and other executive officers assist in the administration of the bank. The first governor of Reserve Bank of India was Sir Osborne Smith. RBI was nationalized in 1949 and its first Indian governor was Sri Desmukh. Reserve Bank of India is managed by the Central Board of the Director presently. This board consists of 21 members besides governor and 4 deputy governors, 4 directors and nominated each by the 4 local board for 4 years terms. Besides then 10 directors and 2 government officers are nominated by the government of India. These boards have been established in Mumbai, Kolkata, Chennai, and New Delhi, respectively. According to the Reserve Bank of India Act, the term of nominated member is for 4 years. Governor and deputy governors are appointed by the government for period of not more than 5 years. Bank's head office is located in Mumbai. The bank has 28 regional offices, most of which are in state capitals. The financial year of RBI starts from 1st July to 13th June. The annual report is released in August each year. Subcommittees of the Central Board. It includes those on inspection and audit, staff and building. Focus of each subcommittee is on specific areas of operations. Its important subsidiary institutions are as follows. Board for Financial Supervision. It regulates and supervises commercial banks, non-banking financial committees, NBFCs, development finance institutions, urban cooperative banks and primary dealers. Board for Payment and Settlement System regulates and supervises the payment and settlement systems. Research Institute. There are various RBI funded institutions to advance training and research on banking issue, economic growth and banking technology such as National Institute of Bank Management in NIBM at Pune, Indira Gandhi Institute of Development Research IGIDR at Mumbai and Institute for Development and Research in Banking Technology IDRBT at Hyderabad. Subsidiaries. Fully owned subsidiaries include National Housing Bank NHB, Deposit Insurance and Credit Guarantee Corporation DICGC, Bharatiya Reserve Bank Note Mudran Private Limited BRBNMPL. The Reserve Bank also has a majority stake in the National Bank for Agriculture and Rural Development (NABARD). Functions of Central Bank. Central Central banking functions of RBI are as under issue of paper currency. The Reserve Bank is nation's sole note issuing authority except one rupee notes, which are issued by Ministry of Finance. It issues notes of the denomination of 2, 5, 10, 20, 50, 100, 20, 200, 500, and 2000. The bank has a separate department for note issuing. This is known as issue department. Banker of the government. The RBI has to work as an agent of the central and state governments. It performs various banking functions such as to accept deposits, taxes, and make payments on behalf of the government. It works as a representative of the government even at the international level. It maintains government accounts, provides financial advice to the government. It provides overdraft facility to the government in case of financial crunch. Banker of banks and a lender of the last resort. RBI acts as a banker for all the commercial banks. All scheduled banks come under the direct control of RBI. All commercial as well as scheduled banks have to keep a minimum reserve 3% with the RBI. They have to submit weekly report to RBI about their transactions by performing three functions. The RBI helps the member banks significantly. They are given below. It acts as the lender of the last resort. It is custodian of cash reserves of commercial banks. It clears and transfer and the transaction. It acts as the central clearing house. Credit control. Control of credit is the principal function of the Reserve Bank of India. Control of credit means expansion or contraction of credit. Reserve Bank of India makes use of all those methods of credit control that are adopted by other central bank in the world. The methods adopted by the Reserve Bank to control credit are suited under two parts: quantitative credit control and qualitative credit control. Quantitative credit control instruments of monetary policy. Bank rate of interest that the Reserve Bank charges from other scheduled bank on the loans given to them is called bank rate. Open market operation. It means that the bank control the flow of credit through the sale and purchase of government securities in the open market. Cash reserve ratio (CRR). It is the amount of funds that the banks have to keep with RBI. If RBI decides to increase this rate, the available amount with the banks comes down. RBI uses this method increase or CRR rate to drain out the excessive money from the banks. Statutory liquidity ratio (SLR). It is the ratio of liquid asset which all commercial banks have to keep in the form of cash, gold, and unenumerated approved securities equal to not more than 40% of their total demand and time deposit liabilities. Base rate. It is the minimum rate set by the RBI below which banks are not allowed to lend to its customers. Base rate is decided in order to enhance transparency in the credit market and ensure that banks pass on the lowest cost of funds to their customers. Marginal cost of fund based lending rate. The RBI has issued new guidelines for setting lending rate by commercial banks under the name Marginal Cost of Funds Based Lending Rate (MCLR). It has replaced the base rate system for April 2016 onwards. The MCLR regime is applicable on floating rate home loan and term loan to small and medium sized enterprises and middle level corporates. Marginal standing facility (MSF) was announced by Reserve Bank of India (RBI) in its monetary policy 2011 to 12 and refers to the panel rate at which banks can borrow money from the central bank. MSF is always 1% greater than RRR. MSF came into effect from 9th May 2014. Priority sector lending. RBI introduced the system of priority sector lending to ensure that banks increase their involvement in the financing of priority sector like agriculture, small industry, etc. Liquidity adjustment facility (LAF) is a monetary policy tool which allows banks to borrow money through purchase agreement. LAF is used to aid banks in adjusting the day-to-day mismatches in liquidity. LAF was introduced for the first time in June 2000. Onwards, LAF consists of repo and reverse repo operations. These are as follows. Repo rate. The rate at which the RBI lends money to commercial banks is called repo rate. It is an instrument of monetary policy. Whenever banks have any shortage of funds, they can borrow from the RBI. Reduction in repo rate helps the commercial banks to get money at a cheaper rate, and increase in repo rate discourage the commercial banks to get money as the rate increases and become expensive. Repo operations inject liquidity into the system. Reverse repo rate. Reverse repo rate operations is when RBI borrows money from banks by lending securities. The interest rate paid by RBI in this case is called the reverse repo rate. Reverse repo operations absorb the liquidity in the system. The reverse repo will be 100 basis points below repo rate. Qualitative, qualitative or selective credit control. Change in margin requirements on loans. Reserve Bank directs the member banks to change their margin requirement from time to time. First such direction was given by the Reserve Bank in May and September 1956 regarding rice trade maximum limit of the loan. With a view to checking speculation, Reserve Bank has fixed maximum limits of loans by the commercial banks. No scheduled bank is allowed to grant loan exceeding 1 crore to any single party without the prior permission or Reserve Bank of India. According to its 20th November 1965 credit policy, this restriction has since been withdrawn. Rationing of credit. It is yet another technique of selective credit control. Under this program, the Reserve Bank fixed credit quota for member bank as well as their limit for the payment of bills. Quota system was introduced in 1960. Moral persuasion. From time to time, Reserve Bank holds meetings with the member banks to seek their cooperation in effectively controlling the monetary system of country. It advises against the expansion of credit except to priority sector, agriculture, small industries, etc. Working of monetary policy in India. RBI decides the monetary policy of a country to control money supply with a view of to check inflationary and deflationary trend. Instruments of monetary policy are classified as quantitative and qualitative, and their working has been discussed above. RBI can influence inflation and growth in the economy to a large extent through its instruments of control. RBI squeezed out liquidity from the economy by selling securities, increasing repo rates, increasing CRR, etc. Then the demand in the economy is reduced and inflation is brought under control. However, in case inflation is due to supply side shortage, RBI controls have less influence. Similarly, increasing liquidity in economy means that households have more money to consume, industries have more money to have invest in plant and machinery, etc., all of which lead to increase in economic activity. Other functions of RBI. Besides this, the above stated specific functions, the Reserve Bank of India performs the following other functions: export assistance. Reserve Bank gives loans to the export industries. These loans are given indirectly by refinancing the loans given by Export Import Bank and other banks. Clearing house function. Being central bank of the country, the Reserve Bank also functions as clearing house. Interbanking obligations are conveniently settled through this house. Change of currency. The bank changing big notes into small ones and small notes into coins. Transfer of currency. The bank also facilitated the transfer of currency. It also issues demand in handis on its branches. Dealing in foreign exchange. RBI is the sole authority to control inflow and outflow of foreign currency in an economy. It is an essential function of the RBI. Being the central bank of the country, Reserve Bank of India also regulates exchange rate of rupee in terms of foreign currencies. It tries to maintain stability of exchange rate. In order to maintain the exchange rate stability, it has to bring demand and supply of the foreign currency close to each other. Reserve Bank deals with the currency of only those countries which are member of IMF. Banks Board Bureau. Prime Minister Narendra Modi has approved the guidelines of Banks Board Bureau (BBB) on 28 February 2016. BBB starts its work from 1st April 2016. BBB will work as search committee and appointments broad appointment of chairman of PSBS public sector banks and will consist of professional with two government representatives, secretary of financial Services and Public Enterprises. Vinod Rai appointed as the first chairman of the bank's board bureau. He was former controller and auditor general CAG of India. The government has maintained the BVV as holding company for state run banks as idea first mooted at the maiden banking conclave Gyan Sangam in January 2015. Indradhanush to revamp PSU banks. To revive the 14 of public sector banks, the government unveiled a 7-point plan Indradhanush encompassing 20,000 crore immediate fund infusion, creation of a single holding company, and minimizing political interference on 14th August 2015. The seven key reforms of Indradhanush mission include appointments, de-stressing, capitalization, empowerment, framework of accountability, and governance reforms. The strategy Indradhanush Rainbow focuses on systematic changes in state-run lenders, including a fresh look at hearing a comprehensive plan to the de-stress bloated lenders, capital infusion, accountability, incentives with higher rewards, including options and cleaning up governance. Monetary system of India. The present monetary system of India is based on inconvertible paper currency and is managed by the Reserve Bank of India. The present currency system is based on minimum reserve system is of note issue. It was adopted in 1957 under the minimum reserve system. RBI has to keep a minimum reserve of 200 crore comprising of gold coins and foreign currencies. Out of total 200 crores, 115 crores should be in form of gold mints. Coins are minted by the government of India. RBI is the agent of government for distribution on issues and handling of coins. Four mints are operation at Mumbai, Noida, UP, Kolkata, and Hyderabad. Symbol of rupee. The symbol of Indian rupee came into use on 15 July 2010. The new symbol was designed by D. Uday Kumar. This symbol is an amalgamation of Devangiri Ra and the Roman R without the stem. Important banking financial institutions: National Housing Bank (NHB). It was set up on 9 July 1988 under the National Housing Bank Act 1987 as a wholly owned subsidiary of the Reserve Bank to act as an apex level institution for housing. NHB has been established to achieve, among other things, the following objectives: to prove a sound, healthy, viable, and cost-effective housing finance system to all segments of the population, and to integrate the housing finance system with the overall financial system, to make housing credit more affordable, to regulate the activities of housing finance companies based on regulatory and supervisory authority derived under the Act. Export Import Bank of India Exim. Exim Bank of India established on 1st January 1982 under the Export Import Bank of India Act 1981 is the premier export finance institution in India. Function: Exim Bank of India has been both an crystal and a key player in the promotion of cross-border trade and investment. Exim Bank of India has over the period evolved into an institution that play a major role in partnering Indian industries, particularly the small and medium enterprises. Mudra Bank. Under the guidelines of Pradhan Mantri Mudra scheme, Mudra Bank has launched its three initiative products, and its name is Sishu, Kishore and Tarun to signify the stage of growth and funding needs of the micro units or entrepreneur. Mudra Bank is refinancing through state level institutions. Mudra will deliver the loan through NVFCS, MFI, one FL and MFLS, rural banks, district banks, nationalized banks, private banks, primary lending institutions, and other intermediaries. Categories are given below. Sishu category: all those business that have been just started at and looking for loan will fall in this category. A loan cover 50,000 will be given to all micro units falling in this category. Kishore category: this one is for those who have started their business, but it has not been established yet. A loan cover from 50,000 to 5 lakh will be given to units falling into this category. Tarun category: all small business which have been set up or established will fall into this category. There may be some financial requirements for the betterment of business. That's why all small business or units falling into this category will be eligible for a loan cover or up to 10 lakh. Establishment year of important financial institution of India. Financial institutions or establishment year: Industrial Finance Corporation of India, 1st July 1948. Industrial Credit and Investment Corporation of India, ICICI, January 1955. Or Unit Trust of India, UTI, 1st February 1964. Industrial Development Bank of India, IDBI, July 1964. Or Regional Rural Bank, RRB, 2nd October 1975. Risk Capital and Technology Finance Corporation Limited, FCTFC, March 1975. Non-banking financial institutions. Non-banking financial institutions (NBFIs) are financial institutions that provide financial services without meeting The legal definition of a bank, one that does not hold a banking license. NBFCs are incorporated under the Companies Act 1956. These include a financial institutions which is a company, a non-banking institutions which is a company and which has as its principal business the receiving or deposits under any scheme or arrangement or in any other manner or lending in any manner. Such other non-banking institutions or class of such institutions as the RBI may with the previous approval of the central government specify features of NBFIs. Small size NBFIs are general small in terms of size and scope except a few NVFIs like Provident Fund, Pension Fund, etc., which are legal large in size. The structure of these institutions is simple and management cost is low. Low capital intensity. These institutions have a very low amount of owned capital. They collect larger sum of money from the people by offering attractive returns. They have to do this as they find it difficult to collect deposits. Easy availability of loans. Borrowers turned down by the commercial banks and development banks approach these NVFIs for loans as they make it available easily with very few documentation requirement. Unsecured loans. The loans offered by NVFIs involve more risk as these are offered without or with inadequate mortgage or security. This results in recovery of loans becoming difficult. Rescheduling of loans. MBFIs convert the loans offered for short and medium term into long term loans when they are not recovered. As a result, amount of loan term and rate of interest increase. Support for economic needs. NVFIs provide loan assistance for several economic activities like agriculture, industry, trade, service sector, and also finance to household sector for consumption, education, home construction, purchase of vehicle, health, etc. Independent policy. NVFIs is in the original organized sector are required to follow certain regulation imposed by the RBI, but capital limitation, profit provisioning, maintaining reserves, auditing of accounts, and publication of balance of sheet, etc., are not binding on them. As a result, most NBFIs conduct their business independently. Types of non-banking financial institutions. The Reserve Bank of India categorized the NBFIs into following categories on the basis of their nature and activities. Equipment leasing company. Equipment leasing company means any company principal business of which is leasing of equipment or the financing of such activity. Hire purchase company. Hire purchase companies are those whose principal business is hire purchase or financing such transactions. The goods are laid on hire by hire purchase company with the condition to pay the installments by the hire, and after all the installments are paid by the hire will have with an option to purchase them later. Housing finance company. Housing finance company is a company which provides finance for acquisition and or construction of houses, acquisition of land and development of land. Investment company. The investment company acquires securities from securities used and released its latter to the investing public. Loan company is a company which provides finance by making loans or advances for any activity other than its own. These activities exclude leasing and hire purchase. Mutual benefit financial companies. Mutual benefits financial companies are usually the Nidhi which are notified by the central government under section 620A of the Companies Act 1956. These companies provide finance to the member of the companies and accept deposits from them. Role of non-banking financial institutions. The role and important non-banking financial institutions is clear from the various functions performed by these institutions. Major role or functions of the NVFIS are as follows. Financial intermediation. The most important function of the non-banking financial institutions is the mobilization of funds from the savers to the investors. Such financial intermediation is economical to both small business and small savers in the following ways. It provides funds to small business which find it difficult to raise funds by selling stock and bonds because of high transaction cost. It is also advantageous to small savers as it diversifies their investments by pooling their funds. Economies of scale. Large, large size of assets in portfolio enables the NVFIs to take advantage of economic of scale in portfolio management. The main economics are reduction in risk through portfolio diversification, employment of professional management to manage funds, low administrative cost of disbursing in large loans, or low cost of establishment, information, and transactions. In inducement to save, non-banking financial institutions play an important role in promoting savings in the country. These institutions provide a wide range of financial assets as a store or of value for savers where they can park their funds. Financial assets have an edge over the physical assets as store of value because they can be stored easily and are more liquid, easily divisible, and less risky. Mobilization of savings. Mobilization of savings takes place when the savers hold savings in the form of banks, deposits, post office savings, deposits, life insurance policies, bills, bonds, equity shares, etc. NVFIs provide an efficient mechanism for mobilization of savings, investment of funds. The main objective of NVFIs is to earn profits by investing the mobilized savings. Different types of non-banking financial institutions follow different investment policies. Savings and loans associations usually invest in mortgage, while insurance companies invest in bonds and securities. Stability in capital market. Defined financial institutions are made available by the NVFIs. The credit needs of different entities are fulfilled. As a result, the mismatch between demand and supply for funds is avoided and stability is maintained in capital market. Providing specialized services. NVFIs work in specific area providing specialized service to people. LIC in life insurance, GIC general insurance, ETI mutual fund for investment in stock market, MD in HDFC in housing finance, and so on. Accelerating the rate of economic development. NVFIs work efficiently throughout the country supported by financial reforms. They help in mobilizing savings and increasing the rate of capital formation, which is the base of economic development of a country. Balanced growth. NVFIs provides easy availability of loans at moderate rate of interest, providing benefits of to defined regions and sections of society. Section of society, small and large, old and new, all types of business or individuals entities can access loan assistance. Providing liquidity. NVFIs offer different types of investment opportunities and saving options, suiting the liquidity requirement of different types of savings and investors in the economy.